Hey guys, Zaman
And Christina
from
from
Our
Our
Rich
Rich
Journey.
Journey. In today's video, we are going to be talking about peer-to-peer lending. In this shared economy that we exist in, there are so many different ways that people are making money. They have places where you can lend out your home to people, lend out land to people. Now they even have places where you can lend out money to other people on these peer-to-peer lending platforms. You give money to people, they pay you back on this platform, and plus interest. And so people have been reaching out to us and really asking us about more details about peer-to-peer lending, how it works, what are the estimated returns, and whether we think it is a good investment. And we love this topic, and so that's what we're going to talk about in this video. We're going to go into detail about all things peer-to-peer lending. We're going to go into detail about what it is, about how borrowers are evaluated. We're going to talk about the taxes related to peer-to-peer lending, the pros and cons, and then we're going to talk about the estimated returns and whether we think peer-to-peer lending is a good investment. Now, before we get into this whole entire topic, we do want to say if you are new to our channel is all about making money, saving money, and investing money on the road to financial independence. Aman and I were pursuing financial independence for 8 years. We reached it, we quit our federal government jobs, and we retired early before the age of 40. So if you are interested in learning about ways to make, save, and invest money, make sure you subscribe to our channel and follow us on Instagram. So let's first start off by talking about what peer-to-peer lending is. So under the traditional sense of borrowing money, someone would go to a bank and ask for a loan. The bank would either approve or deny it and give the money to that person. But under peer-to-peer lending, the bank is not involved. They have platforms that are available where a person that is looking for money will go on this platform, request money from other individuals, and those individuals would allow that person to borrow money from them on these platforms, and in exchange they get an interest rate returned from the borrower.
So let's focus on the investor side of this P2P relationship. If someone is interested in opening a P2P account, the first thing you have to do is find a P2P platform that you feel the most comfortable with. There are a ton of them out there, but typically once you have identified the platform, the process is relatively straightforward. There's an application that you complete, and eventually you deposit money into these accounts. Once your money is in these accounts, you go to the next level of being able to invest that money in people that are looking to borrow money for whatever reason.
So basically these P2P platforms hold your money into an account so that once you begin reviewing requests from borrowers, and if you ultimately decide to loan money to these borrowers, the P2P platform takes money from your account and sends it over to the borrower. Well, one of the nice things about this is that the platforms also rank borrowers, and they're ranked on their risk profile. So they look at things like credit history, credit score, debt to income ratio, bankruptcies, collections, even job histories. And then they rank these borrowers from a very high risk to very low risk. And depending on the level of risk, if someone has a higher risk of default, for example, you will potentially get a higher interest rate from loaning money to that person. If they have a lower risk of default, the idea is that you're going to get a lower interest rate from that person if you loan money to them.
But the overall idea is that the peer-to-peer lending platform is providing this information to you in order for you to make the decision. It is up to you whether or not you want to invest in someone that is more riskier in exchange for a higher rate of return, or if you want to be more conservative and invest in someone that has a better chance of paying your money back. By doing so, you're going to take on a lower interest rate, but the idea is that the risk of investing in that particular borrower is also lower.
So assuming that there's no default or late payments, all of the interest that you receive is made to you into this account on a monthly basis. And I mention this because this is a great transition into the pros and cons of P2P lending. So we're going to start off with the pros. And the first pro is those monthly payments. Like I said, when you set up your account, when you lend money, you're supposed to be receiving interest payments each month. Now, this is in contrast to dividend payouts or when you're collecting interest on bonds, which typically happen on a quarterly or semi-annual basis. So with P2P lending, you get that monthly income that's coming in.
The next pro is the potential for higher returns. A lot of the P2P platforms advertise interest rate returns that are higher than CDs, bonds, and money market accounts. The last pro is diversification. With many of the P2P lending platforms, your funding can go towards a portion of a person's loan. You don't have to fund an entire loan. So you can spread the risk amongst many different loans with your dollars.
So I'll give you an example. If you want to fund a high risk loan, but they're asking for $1,000, you can fund, for example, maybe just $25 of it. And then you can fund a lower risk person with $25. You can spread your money across multiple different loans with multiple different risk profiles.
So let's get into some of the cons. One big con is defaults. Now, one of the reasons why peer-to-peer borrowers go to these platforms is because they don't qualify for loans at banks. And so they're coming here with maybe not as good of history of credit, and so the risk of default is a lot higher. And when someone defaults on a peer-to-peer loan, you lose all of your money.
The next con is that the majority of these loans on these peer-to-peer lending platforms are unsecured. That means there is no collateral in the event of a default. So you lose all your money, you're not getting interest payments, and you have nothing else in exchange for that default. There is no collateral.
The next con is that the money that you deposit in a peer-to-peer lending platform is not FDIC insured like it would be if you deposited that money in a traditional bank.
And this is really big because these peer-to-peer lending platforms are really selling the idea that if you invest with borrowers on these platforms, you're going to be making more than a traditional bank account, for example. But if you have your money in a bank account, like Aman said, that money would be insured by the FDIC. If something happens to your money in these peer-to-peer platforms, if the platform shuts down or if you get a default on the money that you borrow, none of that money at all is insured.
The next con is management fees. And you know we are not fans of fees on our investments. But when you invest in a peer-to-peer lending platform, you are also being charged management fees for the money that you are loaning out. And to us, that sounds a little counterintuitive. If you are an investor in a loan, shouldn't the person that's getting the loan be charged the fees? But as the person providing the loan, in most cases, you are also being charged a fee by the platform, and that cuts into your returns.
So our final con with investing in peer-to-peer lending has to do with your rate of return. And this actually segues perfectly into whether or not we think peer-to-peer lending is a good investment. And our return is what we really focus on when we're making investments. And if you look at peer-to-peer lending platforms, the return is very unclear. And I'll give you an example by looking at two of these very popular peer-to-peer lending platforms. The first one is Prosper. So if you look at Prosper, they rank their borrowers from a high risk profile to a low risk profile, and they say their estimated returns for investors are 3.6 to 13.9% for lending. Now, if you look at the fine print though, they say that these estimates require a significant assumptions about the repayment of loans.
And it's this fine print that gives us a little worry when it comes to investing in peer-to-peer lending platforms. Because in order to get the highest return, the 13.9%, you have to do two things. One, you have to make significant assumptions. Number two, you have to invest in the most aggressive loans with the highest defaults. These are two things that we feel uncomfortable doing just for a 13.9% return.
So here's another site called Perform. It's another top peer-to-peer lending platform. And with the estimated returns on this site, it doesn't even begin to estimate those returns. Instead, it says that there are compelling risk-adjusted returns for investors. So again, when you're investing in these peer-to-peer lending platforms, it's really hard to determine what the actual return is. So you really have to understand that going into these types of investments.
So considering the pros and the cons, the question of this video is whether or not P2P is a good investment. And at least from our perspective in how we like to invest our money, we do not think it is a good investment. I mean, if you look at the Prosper example, in order to get the maximum return, it requires the maximum amount of assumptions and the maximum amount of risk. and it's only 13%. We know that there are many more other investments out there that we can get 13% on. We have gotten a lot higher percent investing in index funds and ETFs. And so for us, when we're looking at investing our money in P2P, we can't help but look at these other investments and say, why take on that P2P risk of losing all your money in some cases when we can just invest in an index fund or an ETF that even outperforms the P2P lenders.
And for people that are willing to take on higher risk for higher returns, there's always that availability by investing in the stock market. People choose to invest in individual stocks, for example, but at least with individual stocks, you can look behind the fundamentals and the financials of the company and really get an idea or an overall sense of your potential return by investing in a particular company. With P2P, you really don't have that sense. You don't have that ability to make those projections.
So this was our perspective on P2P lending. We hope that we've answered the questions that you have been asking us about this particular investment. And so, as we always like to say, you must do your own research and make an investment that fits your needs and your lifestyle. And so, as usual, if you like this video, please give it a thumbs up, subscribe to our channel, and join the journey.